Hey guys, Whitney here. Thanks so much for joining me today on the Passive Investing Made Simple show. If this is your first time joining, welcome. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com, and I will be your host. This is a live show where we deep dive into all the ins and outs of passive real estate, so you can be confident in going in your first or next investment. So be sure to hit subscribe, like the show, and visit passiveinvestingwithwhitney.com for future masterclass sessions, and even check out our open deals. And if you'd like to jump on a phone call with me, before we dive into actually, that's the intro. I'm going to leave it at that. All right. So to kick off today's show, I have a very special guest here with me today, our very own Director of Acquisitions, Eric Fitzgerald. Eric, welcome.
Hey, Whitney. Hey, everyone. Thanks for having me. Appreciate it.
Yeah, I should say welcome back. This is not your first rodeo here.
Yes, I think we're getting pretty good at these by now.
Yeah, excellent, excellent. Well, Eric, for those of you, or for those people who are just joining for the first time, take a moment and introduce yourself. Let them know how you got into real estate and what your role is here at passiveinvesting.com.
Yeah, so originally I was a pre-med major in college, and I hit organic chemistry and reached a mutual agreement with organic chemistry that that was no longer my path. So really had no idea what I wanted to do, kind of switched my major into business, dove into places like biggerpockets.com, listened to a ton of podcasts, webinars like these, and kind of built my knowledge base, and then took that into real world work experience. So I worked for a company during college called Morgan Properties, who's actually the largest private landlord now in the United States. So worked for them near Philadelphia for a little while, doing property management, real estate investment things there. Went back to school, got a job as a snow shoveler for a student housing investor on my campus. So those northeastern Pennsylvania winters, there's a lot of snow and a lot of ice that needs to be removed. So that was my job. Kind of built that into eventually managing his portfolio and kind of letting him take the back seat on a lot of, what he was doing on a day-to-day basis. Learned a ton about operations, property management, development, investments during that time. Graduated from school, moved down to Charlotte, North Carolina, got a job as an analyst, underwriting and transacting on multifamily properties in the Southeast, and then worked as a acquisitions associate for family office after that, heading up acquisitions in the Carolinas while they were based in New York and Chicago. Joined Passive about 2 years ago, and I've been the director of acquisitions, kind of overseeing multifamily and car wash. We've been fortunate to do about 1.4 billion of transactions in my time here. So again, happy to be here and hopefully, add some value today.
Awesome. Well, first of all, congratulations to your anniversary with passiveinvesting.com. That's amazing. And just all the success you've had here. So I am super excited for you to impart some knowledge to our crew here today. So let's dive in. All right. I know we have some acronyms out there, NOI, EGI. Let's first define what those are.
Yeah. So NOI is net operating income, and EGI is effective gross income. So your EGI is your kind of gross income after your gross potential income minus your vacancy, minus your bad debt, any kind of top line items, and that's your effective gross income. So how much is the property pulling in before expenses, before debt? Then your NOI is how much income is the property pulling in after EGI minus all operating expenses, not including debt. So this is only your income minus your operating expenses would be your NOI.
Okay, awesome. And why is it important for us to have a business plan that grows these two numbers, especially the NOI? Like, why is it important for us to consider that as investors?
Yeah, so on the commercial side, all multifamily products that we evaluate are based on NOI and cap rate, and that's how they're valued. So if you have a certain NOI, income, maybe kind of illustrating the math behind it would be helpful. So If you have a 300 unit property and you're getting like $50 rent bumps on every single unit on that property, that's then bringing in $180,000 of additional NOI per year to the property. So how that $180,000 of additional income gets translated into the value of the property is taking into account a cap rate. So the cap rate is, it's technically defined as what price you're paying. If you're paying for cash, all cash for property, what return you would get for that investment. We use basically a 6% cap rate for example purposes here. Take $180,000 of income, divide it by 0.06, and that would give you $3 million of extra valuation for the property just by raising your rents by $50 across the board on a 300 unit property. So you can see kind of the multiplier effect. As you raise income on one unit, you can get the scale, raise it on 300 units, and that impacts your valuation a huge amount, which is why we like larger properties. It's why we like scale. It kind of, gets you to a higher valuation quicker.
All right, so I have a question for you because there's so many, and myself included. I used to be a single family property investor. I can raise the rents on my single family property. How do I get value for that? How do I increase the value on that? What's the difference?
Yeah, so the single family is more based off of market comps, right? So if you're the property down the street that looks like yours and was built in the same year as yours and has the same amenities as yours, sold for $300,000, there's not really a whole lot you can do to your property to make it worth much more than $300,000 just because it's valued off of a comparable basis. But on the multifamily side, it's strictly valued and defined on what is the income that it brings in and what premium are investors willing to pay for each dollar of income, which is the cap rate.
All right. Okay. Well, let's take a little detour. Okay. If you'll entertain me for a second, let's talk about that cap rate. Let's define it, because I know I hop on the phone with investors and some of them are like, don't you want to buy at a higher cap rate and then sell at a lower cap rate? I'm like, yes. And how does cap rate get determined in a market?
Yeah, so there's a lot of kind of things that go into account with cap rates. So if you're taking, for example's sake, if you're taking a, 2022 built brand new Class A development that's 100% occupied and was built by an institutional developer, right in kind of a major thoroughfare of Tampa or Charlotte or Austin, Texas, people will pay a higher price for every dollar of income that property brings in than they would pay for a 1970s built asset in, I'm going to offend someone by saying a city. So let's just say Kansas City, because I'm an Eagles fan and I don't appreciate the Chiefs. So let's say Kansas City is our example here. So, an institutional or any investor will pay a higher dollar or a higher purchase price per dollar of income for the property in, Charlotte that's brand new and 100% occupied and beautiful than they would for the 1970s deal in Kansas City. So it's just a way of kind of valuing different assets. So for example, the new build may be a 4 cap and the Kansas City deal may be a 7 cap. That's a 4% and a 7% cap rate.
So who sets the cap rate?
So the brokers will try to set the cap rate when they kind of value the property. They will, look at the NOI, which is what we talked about earlier, and they will associate a cap rate to that NOI. And there's other things that go into it as far as what is the debt market and all these other kinds of variables that are at play. But generally, the broker will kind of present a BOV, which is a broker opinion of value. They'll give you a range of exit prices based on different cap rates that they think buyers would be willing to pay. So the lower the cap rate, the higher the price a potential buyer would pay. So brokers will, set a market cap rate, and then eventually the market will set the cap rate for the transaction. So you get 50 buyers underwriting the deals, usually more. Maybe you get 20 offers on the deal, and those offers, depending on what purchase price they're offering at, could be between a 4% cap rate and a 5% cap rate. The people who are offering the higher purchase prices are offering based on a lower cap rate because maybe they believe in the area or they have some kind of knowledge about what's going to be happening in the area. They have some reason to be paying for a lower cap rate, which also means just paying more for every dollar of income that the property is bringing in. So eventually the market just sets the cap rate based on what investors are willing to pay for the asset.
Okay. Now I wanted to spend a lot of time on the cap rate because we're going to get into the logistics of like how we actually model that value increase, right? What are all the things that we can do to amplify NOI? And I know the question, and I had this, I still have this as a limited partner investor, but I know many of our investors here have the same question: is if cap rates if cap rates can fluctuate with market, what somebody's willing to pay in the market, how does that translate into value? And essentially, it's like, are you dividing by 5% or 4%? If you're increasing NOI, you're still making money. So let's dive into that, right?
Yeah. So I think, as far as buying institutional quality assets, which is what we, try to do, for every dollar of income that you're increasing on a property, if you're selling at a lower cap rate, that just means more value that you're creating on the back end as well. So, the ideal scenario would be to, find a deal for a 5% cap rate and improve the NOI, improve the operations on the property, buy at, generally the right time in the market cycle, and then be able to sell that deal for a 4.5% cap rate or a 4% cap rate. So be able to have some of that cap rate decompression to create additional value on the property. Now, in this market, you shouldn't be expecting that or kind of underwriting that, but that is ultimately the goal, is to, obviously improve operations on the property and do all the right things on a day-to-day basis, which I think is the most important thing. And then any kind of cap rate compression you have in the market around you or anything like that is just kind of the cherry on top or icing on the cake on your exit price.
Awesome. Okay. So let's show some math here before we dive into the different levers we can pull. So same property, 300 units, we increased the rent by $50 a unit. So we created what you said, 1.8 million or 180,000, sorry.
Yep.
Okay. So we divide that. So what would be the increased valuation if we bought it at a 4 cap and we exited at a 4 cap?
So at a 4 cap, that would be $4.5 million of additional valuation compared to our 6 cap example, which was 3 million. So an additional 1.5 million on the exit if we exit at a 4 cap compared to a 6 cap.
But in either case scenario, you're still creating value on the property, which is what I love. And I think that's where investors need to kind of hear when they're investing in this market. We all want that cap rate to go down, to compress, as you say, but even if it expands, we are still creating value on those assets. Okay, shareable equity with our investing partners. All right, so let's talk about how we do that. What are all the different ways that we can affect that NOI?
Yeah, I've got a list up here. So the first one is always obviously going to be raise the rents. Now there's, ways you want to go about raising rents, and it has to kind of be proven out. So on the upfront kind of scenario of the deal, we'll look at all the comps in the area, the vintage, how nice they are, where they're located, what does the resident base look like? And so we'll go in and see, is there room to kind of bring these rents up to the market? We'd like to understand the story of the seller and the story of the management company to see, where some operational efficiencies might come into play. But that's always going to be the first one, is like that example, increasing $50 of rent on a 300 unit property brings you $3 million of increased valuation at a 6 cap. So that's the one everybody goes after. That's why the value add space has been so popular. Obviously, you want to be conservative on your projections on rent increases. You want to understand, not only what's happening in the submarket, but also what's happening in the market. What's the supply and demand balance? What's the net absorption? Are there a lot of Class A units coming online in the next 12 months that you kind of have to think about? Will they be offering concessions to kind of, cut back rates a little bit? So a lot of things you have to think about when, it sounds simple as, raise rents, and it has been simple for, the last, little while, but there is needs to be a business plan around it, and a defensible kind of strategy to do so. So that would be one. Another would be to maximize occupancy. And so we actually don't like to go above 95 or 96% occupancy, only because that probably means your rents are too low. If you're kind of hitting the 97, 98, 99, 100% occupancy. So, that's kind of a sign sometimes that your rents are probably too low. And, we like buying from sellers that keep their properties at 100% occupancy, because we know there's a lot more room there to kind of bump rents and test the market and, see where the ceiling is at. And there's a lot of operators out there that are fine, just operating at 100% occupancy, and, they don't have, really investment partners that they need to maximize the value or the NOI, and they're just kind of on autopilot. So, that's one thing to look for when you're looking at deals is, what is the owner situation? Maybe they're operating at 100% occupancy. So we like to go in there and kind of analyze that. But also, you don't want to be lower than 95 or 96 either, because obviously then you're losing out with the vacancy loss on your EGI. So, a tight balance there. And luckily, we have a good team with Brian Bordenhorst on our team, as well as FCA management that keep track of all that and make sure that we're, doing the right thing on that side of things. Another is rent collection. So on our Class A assets, fortunately, we haven't had many issues with collecting rent or with tenants qualifying or anything like that, which is another reason we like the Class A space. A lot of our all of our incomes on our residents are 3.5 up to 10 times the monthly rent amount that they're paying. So they're not in an affordability crunch like a lot of the Class C properties are. And the delinquency issues on Class C properties are a big, thing to kind of analyze when you're looking at deals. So you want to make sure that your property management company is staying on top of any late, payers, and making sure they're sending out notices and following very strictly, the late fee process down to the eviction process, and making sure that that's a firm process and you're not, treating someone else differently than somebody else, because that's a fair housing violation. So there's a lot of things that go into that. Another would be to add units. So sometimes there's opportunities to turn a storage area into 1 or 2 more units. There's a deal in Charlotte that we had looked at last year that had a quite an odd kind of development, and in the basement there was this huge storage area that was barely being used, but it had kind of these elevated windows at the top. So there was a potential play there to add units, and we didn't end up purchasing it. And I'd be curious to see if the buyer ended up, actually doing that or not. But that's kind of like creating income out of thin air and creating valuation out of thin air if you can find those opportunities to add some units to the property. The other obvious one is to reduce expenses, and this is a balance just like the occupancy. You don't want to decrease them too much, but going in and finding efficiencies in payroll, in your utility costs. We use property tax consultants to make sure that any property tax assessments we get are in line with market values, and if not, we have them appeal it and kind of go through that whole process. So there's a ton of things we can talk about on the expense side, and your property manager should be in tune as far as what are the market expenses for that particular submarket and that particular product type. So they should be able to help give you feedback, which is what we do with FCA on what would it take to run this deal the right way. And we also look at the trailing 12 financials to see how the seller's currently operating. Maybe there's a couple line items that are out of whack, and we just want to better understand if that's the way that they operate the property, or if it's that's the way the property actually operates, and we have to underwrite for an increased cost or something like that. Another is to improve reputation and online reviews. So I know in the car wash space, this is really, really big for us, trying to get really strong Google reviews. And it's, I think, less widely spread in the multifamily space, but I think it should be. Tenants always are going to look at your Google rating. They're going to look at their reviews. Anytime I'm looking at an apartment, that's what I do. One of the first things, just to see what is the reality like for a resident living on that property. What are some potential issues? And this is something that we do for any deal that we're looking at acquiring as well, because we might find any number of issues, water leaks, rodent issues, pest, infestations. So there's a lot of different things you can find out on Google reviews, and making sure that your property is, a 4.5 star and above goes a long way in the local market to attracting new tenants and making sure you're staying full occupancy wise. Obviously physical improvements as well as the last one I have here. So this could be, going in and putting some fresh paint on the shutters or the doors. It doesn't have to be, going in and stripping everything out and doing some wild, gut project. Even just curb appeal, landscaping are things that we focus on when we're going to acquire a new deal. We typically set aside 50, 100, 200,000 and up to just improve curb appeal, improve the exterior look of the property, improve amenities. All of this is hard to quantify on the exterior as far as rent bumps, and I think people don't focus on it as much. Because the interior unit renovations is pretty simple. You spend $5,000 on new countertops, new paint, new hardware, new appliances, and maybe these days more like 8,000 or 10,000. But you spend that money and you get a pretty foreseeable rent bump that's coming of in place of $150, $200, $250. But when you do the exterior stuff, that gets people to stay in their units. It reduces turnover. People, are proud of where they live. And so that's, I think something that's a little bit kind of underserved today is kind of some of the exterior improvements. But yeah, those are a few.
Awesome. All right. So you referred to car washes, and, we do invest in self-storage and car washes. Same kind of principle applies, right? As far as like the valuation by increasing the profit, if you will, on the property. Is there any differentiations that we need to draw between self-storage and car washes before we move on to risk mitigation?
Yeah, I think for car wash, it's a little bit different. A lot of times we will base that off of an EBITDA multiple. So, we might be buying a car wash at 6 to 10x on the EBITDA, which is a trailing, basically NOI for car washes. Think of it that way. And so we'll buy, a 6 to a 10 multiple on the EBITDA. We'll underwrite to exit around that, kind of trailing EBITDA number as well. But we do everything we can to, again, increase income, decrease expenses, and a big thing in the car wash space is the memberships. We had a grand opening at our Fort Myers site, which was in Pick Car Wash 4, I believe, on Colonial Boulevard. And they sold 762 memberships in 3 days on that site, which absolutely crushed our underwriting projections pretty much for the year. So, that was really good to hear. And, doing it, having efforts like that to really, take the professionalism that we have in multifamily and the management expertise and bring that, full force in a car wash and really just kind of crush the competition was cool to see. So, obviously that'll have an impact on the valuation on the back end because we've increased the EBITDA by signing up, that amount of members.
Awesome. Amazing work. All right, let's talk about risk mitigation. What does an operator need to have in place in order to mitigate the downside and protect the NOI essentially?
Yeah, I think, knowing your market is a good, place to start for that question. A lot of people, I think probably try to get spread too thin too quick and, are looking at a ton of markets and don't really understand any of the markets that they're in. So what we do before we make a purchase in a market is we'll go down there and spend a couple days to a week, just boots on the ground, meeting with every single brokerage company, every single, top producing broker. We did that in Nashville last year. We ended up buying a deal, a few months after that. And, one of the meetings that we had in Nashville, we sat in a conference room with one of the, major brokerage firms there, and they put a projector up, on the screen and just went through on a map of Nashville, where are things happening, where are things not happening, where's the crime. And this was all, not on a specific deal. So we made sure they weren't trying to sell us on one area. We didn't tell them any deals that we were interested in. We just wanted to see, Nashville as a whole, where are the good pockets, where are the good spots, where's the, path of growth. And so that's, a good place to start is, you're taking a lot of risk by entering a new market. So making sure you understand what are the sub-market demographics, what kind of things are happening. Like I said before, the supply and demand imbalance, making sure that's in line, because you can buy a deal and then 12 months later, there's, 800 units delivering right in your little sub-market, and you're not going to look good on your rent growth and your occupancy, because of that. So that's going to be a big piece of that, is knowing your location, knowing your market, and also knowing your product type. So, knowing, going in, what should I be looking for if I'm buying a 1970s asset versus a 2022 asset? You need to be looking at plumbing, roofs, all kinds of the major CapEx items in the 1970s vintage. But in the 2022, you need to be looking at construction defects, making sure things are covered under, warranty, and making sure everything is kind of built to code and everything is straight, that way. So location, making sure you know the location, and then making sure you know your product type are two big pieces to that.
Awesome. All right. So what is the biggest takeaway that you want listeners to get from this episode, especially as they're considering investing in the new year? And I say new year, it's like halfway through February. But this year.
My biggest takeaway here, I guess, there is a lot that you can do from a hands-on perspective to increase value on your property. And so making sure when you're looking at, the OMs or any kind of investment offering, you're looking at, where is the exit cap rate? Where is the trailing cap rate? Making sure there's a little bit of a delta. For us personally, we do sensitivities. So based on different exit cap rate scenarios, if the market turns, what will our returns be? What will our exit price be? So making sure whatever group you're working with has those sensitivities in place and is not underwriting for, cap rates to go down or, even stay the same, or, any kind of thing like that, I would say to make sure you're watching out for. And then, if you don't understand the math behind how cap rates and NOI influence valuation, I'd say to, make sure you understand that. So like the example we talked about earlier, maybe, watch the recording again, but it's so powerful. And that's what really sold me on multifamily, is the ability to increase value on a property. It's so scalable in multifamily. Like I said, if you increase, $50 of rent per unit, how much kind of exponential benefit there is to the valuation on the back end. I'd say that's a really important piece of this conversation.
Well, and it's not just what can you do in year one, but it's what can you do that those rent growths compound over time as well, right? So you might get a 10% bump year one, and then a 10%, maybe another 10% bump in year two. And guys, that's high. That's a high number. I realize that. But those compound on top of each other from what you originally entered in with rents. So Eric, 100% agree. Well, Eric, thanks so much for joining us today. If somebody wants to reach out to you and get in contact with you, what is the best way to do that?
Yeah, you can email me at eric@passiveinvesting.com. It's ERIC@passiveinvesting.com.
Awesome. Well, guys, if you're joining here live, don't go anywhere. We're about to start our Ask Me Anything session. But I want to say thank you to all of you who have joined or are listening on your favorite podcast player of choice, or maybe viewing us on YouTube. Be sure to register at passiveinvestingwithwhitney.com to check out future masterclass sessions and see our open deals.